10-year note yields printed their lowest this week. That's very significant, being that it is the effective funds rate. Likewise, what we're seeing with the yield curve with 2, 3, 5, and 7-year note yields all below that effective funds rate. It's interesting that we settled right at 240 or right near 240 for the week. So the 10-year note and the overnight lending rate are both right on top of each other. That seems to be creating quite a buzz on Wall Street as well as LaSalle Street, and I think that if it hasn't been a catalyst for the move already, it's going to continue to be so. One of the two needs to move, whether it be the effective rate going lower via Fed rate cut or via the 10-year note yields going higher via economic data, via Fed, via whatever, but they can't stay on top of each other forever in any normal market. So right now, yields hovering on their lows. They are off the lows. We did get down quite much lower than 240 this week, but we saw a little bit of a rise. I think a lot of this buying in treasuries has been have to type buying, not want to, which means that there may be some that were buying at levels that weren't as attractive because they had to, and that may have pushed yields down to their lows. So right now, treasury yields still near the lows and have to make a decision in the coming weeks as to whether we're going to see a breakout from the effective rate or we're going to see 10-year note yields go higher. Like I said before, one of them has to move over the next few weeks. Let's go to volatility. Market volatility did see a big move higher. We didn't get to the year-to-date highs, which were posted on January 3rd in Treasury volatility, but we did get as close as we've been since then. And ultimately, I think that the market right now was basically, we traded outside of the range. The old range was 260 to 280. Then we shifted it down 250 to 270 and for a brief period, and then obviously we got the big breakout. So I think ultimately the market, as we trade higher yields, will see lower volatility. Likewise, if we get down to those lows again, things should be firm. Obviously, a flight to quality bid accompanied by uncertainty is certainly one of the reasons for driving vol, but it's basically been a very much position trade here as I think shorts are getting the squeeze. Likewise, the have-to buyers will continue to pay up. Lastly, let's look at what we have coming up ahead. Retail sales and employment, both expected stronger than last month. That will be good for the Fed. Likewise, I think that GDP numbers that have been expected via the GDP Now out of Atlanta has suggested that we may see first quarter GDP below 1%. That has changed. We've seen a modest shift higher. It's still below 2% and not where the Fed wants it, but certainly better than what we've seen. So right now, those numbers could help aid in pushing yields higher next week. Obviously, there's still that whole Brexit hangover that we heard about this week. Likewise, dealings with China and the U.S. Nothing is clear yet, and I think those are things that are going to have to find some balance. Lastly, the Fed needs to figure out what it's going to do with the short end of the yield curve, because right now that continues to confuse. So right now, heading into the weekend, 10-year note yields still on their lows, but for how much longer?